Hi, good evening, each one of you. Thank you for joining this webinar. Let's go ahead and start. I think most of them have already joined the session. So, we are looking at today's webinar. My name is Vivian, and I will be taking today's session. We'll be looking at few technical indicators today. So, I'm going to keep it as basic as possible. And for those of you who already have knowledge of technical analysis, hope it adds more value and knowledge to the experience that you already have. And for those of you who are very new to trading or very new to technical analysis, do not worry, I will keep it as simple as possible. If you all have any questions while I'm taking the session, please do feel free to write down in the chat or the Q&A section, and I will try and answer as many questions as possible. So today we are looking at simple technical analysis that we could use to identify opportunities in the market. But at the same time, while identifying opportunities, these technical analysis will also help you understand the risk and the reward that each opportunity presents itself. And we'll also look at how each of these technical indicators form and how you can use them to your advantage, and how you can also use them to maximize profit and minimize risk. Always, any trading or any investment that you're doing, you should always have the risk that you always intend to keep in mind. And any trading decisions that you make sure you always have a risk management in place. So these technical analysis or these technical tools that we're going to be discussing today will help you identify all those opportunities, along with where to keep your take profits and stop losses. Just before I start off in getting into the technical tools and the technical analysis that we could do. Let's look at what a technical analysis actually is. So there are two types of analysis. Basically, there could be even three types of analysis that an investor or a trader does. But the most basic ones are technical analysis and your fundamental analysis. Now, what is the difference between technical and fundamental analysis? Fundamental analysis is got to do with, let's say, for example, you're looking at Apple as a stock, and if you want to do fundamental analysis, you're going to be going to look into the history of Apple. What kind of products do they produce? What kind of sales do they have? How has their growth been over the last couple of years? How are their financials looking? How is their revenue quarter on quarter, year on year? So you look at the growth aspect of the company, but at the same time, fundamentally, you will see if the company is a sound and stable company that you want to be invested in, depending on what product and technology and innovation that they have for the company, and also the future prospect of their current innovation being innovated further so that they get more revenue and sales in the future. And hence, you do an analysis based on these few factors. There are more factors. I'm just giving you few of the examples what goes under fundamental analysis. Whereas when you're doing technical analysis, you do not consider, of course, you do consider fundamental analysis before you invest into any kind of product. You understand that product is first worth investing in. Now, once you understand that the product is worth investing in, now the next challenge is, when do you buy a product and when do you book your profit? What kind of returns can you expect? What kind of downside could you see if the particular stock or a commodity goes against you? Now, this is where technical analysis helps you. Technical analysis basically is analysis of pretty much the price movement that has happened on a particular stock or a commodity or an index or even a currency. So you look at the analysis, you look at patterns, you identify patterns, you find out where the prices have been in the past, where the prices have gone up, and to what extent has it gone up, or to what extent has a particular price dropped. Now, putting technical analysis, you look at the price action, and these price actions help you analyze when to enter the market, when not to enter the market, or if you're already in the market, when to be cautious, and when you if you're already in profit, what kind of profit could you expect going forward, looking at technical analysis. So, and hence technical analysis becomes a very key factor for especially people who are trading on a smaller time frame. Of course, technical analysis could be used even for a longer time frame. If you're looking at investments, you could still use the technical analysis to identify where you could buy, or where you could start investing into the market. Please note that every indicator that gives whether a signal towards a time to invest in the market or to exit, risk management is the first most thing that we need to keep in mind with every investment or trading that you do. Now let's get into a couple of indicators we'll look at today. Very basic. Now this is not an indicator. This is basically how a line chart looks. Line chart basically represents, of course, you would have seen bar charts, you would have seen line chart, and if you're already trading, you'll see a lot of candlestick patterns. Now, line chart is one of the most basic charting that you could see. Line chart pretty much helps you identify the trend, the ups and downs in the market. Each line represents the time frame where the pricing has closed, and the line chart continues depending on what timing you are looking at. Now, the second type of chart that you can look at, which has little more detailed information in it, is the Japanese candle. I'm sure most of you all would already be tracking markets. If you have not been, and this is the first time you're looking at a chart, if you are looking at a candlestick chart, this is how a basic candlestick chart looks. Now, each candlestick has a body and it has a wick. Now, very easy to understand, the body always represents the open and the close, whereas the tail always represents the high and the low. You could see possibilities where you might not see a tail, or you could be you're seeing a possibility where the body is very small but you have a very larger tail. What I will be doing in the future examples is I will be showing all of these candlesticks even on a live chart, so it's more easier for you to understand. But just to keep the basics in mind, the body always represents the open price and the close price. For example, if I'm looking at a daily chart, each candle represents a daily move. So basically, today's candle has not yet closed. So the candle could close higher, could close lower. Now, let's say in this particular example, it shows open at the bottom here, and when the prices went up, it went as high as this, and it eventually closed here. So hence, it is a green candle, and vice versa for a red candle. The red candle usually the price opens higher, and if the price for the day closes on the lower end, it forms a red candle. Now, if you're looking at a daily chart, that signifies every candle represents a day candle. Whereas if you're looking at a 5 minute chart, every candle represents the last 5 minute candle or the moment. The last 5 minutes, where did the market open, and where did it go in terms of upside and downside, that is the high and the low, and where it closed. If it closed higher than where it opened, it's a green candle. If it closes where lower than where it opened, it is a red candle. Now that's how a basic candle pattern would look like. Now, coming to the most important thing that a lot of technical analysts do is try and identify support and resistance levels. So, what are support and resistance levels? For example, let's say we have a particular product, or let's say there is a stock by the name of ABC. It is trading at $10 a share, and we see the prices going up. Let's say it goes up to $15, and then probably a week later it comes back down towards $10, and then again we see the prices going back up to maybe 16 or $17, and then you see the price again come back to $10. This time, probably when it goes back up again, it might just go back up only till $12. Again, it comes back to $10. Now, it is very evident, even without a technical analysis. You understand, every time it comes down to $10, the prices has been picking back up, and these are the few indicators technical analysts look at to identify where the buyers are most likely coming back and buying it into the market. And not all the time it is going to be at the same level. It can always be a level where it comes down on a trend line support, or when it comes down to a support like the $10 example that I gave you, that will be a flat support, whereas there will be trend lines which I'll be discussing in the future, as in the next few slides as well. Now, basically, how do investors take advantage of this? Trade the bounce. Basically, every time you see the market come down by, let's say for example, there's a stock that goes up by 10% and it drops by 5%. After every 5% drop, it eventually recovers and again goes up by 10%, and then again you see it drop by 5% from the new high. So every time you see a 5% drop, you understand that is making a new support. Basically, the buyers are looking to buy back on every dip. So every dip is a buying opportunity. Now, how do we use technicals to identify those? That is what we are going to be getting into the next couple of slides. Now, these form your support and resistance. So I hope everyone's clear on what forms a support and what forms a resistance. Now, going forward, how do you plot support and resistance? Now, the example that I gave you earlier was a stock which I made up, which was trading between $10, $15, comes back to 10, goes to 12, comes back to 10, goes back to 18, eventually comes back to 10. So we understand that every time it comes to 10, it is taking support, and that's what is meant by support. Now, in this particular example, you see the reverse of it. You see the market going up, it takes resistance. This is basically S&P 500 chart where we see the market going up, taking resistance, dropping back down again. You see the market again eventually pick back up. It went to the same level, drop back down again. This is the third time it went to the same level, drop back down again. Now, there's one rule that most technical traders follow. For you to identify something is at support, or in this case at resistance, it should have minimum 3 points that it touches before you take any action on that specific resistance or the support. Now, in this case, this was the first time it touched, this was the second time it touched the same resistance, and this is the third time it touched the same resistance. So the fourth time it touches the same resistance, investors or traders will expect the prices to drop back down again now, because this is considered as a very strong resistance. What is a strong resistance or support? When the price does not breach multiple times, minimum 2 to 3 times is what you need to look at. Moving forward, trend lines pretty much works similar to what we saw over here. This is a horizontal line. Trend line is where you see the market which is going down, goes back up, but makes a higher high, sorry, lower high. It makes a lower low, but eventually when it goes back up, it makes a lower high. And if this pattern keeps continuing, you can draw a trend line connecting all the top wicks or all the top candles. This is more easier on a line chart as well. So whenever you see this resistance, now you understand it is a downward trending market. But although it is a downward trending market, every time it pulls back up, it is a shorting opportunity for those of you who understand shorting. Vice versa, for if you do not understand shorting, do not worry. Here's an example where you can buy the dips. So every time the market came down, it bounced back up. You see the market. So you see this was the first point, second point, third point. Now three confirmations. The fourth point onwards is where you can take a trading decision. I have a question. If the script comes back after resistance third or fourth times, is it a reversal? So, from what I understand by your question, if it goes back up for the fourth time, is it time for reversal? Yes, that is how it is considered, where the resistance is strong, hence the price is not able to breach. So, every time it goes back to these levels, we expect the prices to drop. Now, of course, it is not always the case. There are cases where three times it has taken resistance, and the fourth time it could very much break above and keep continuing moving forward. And that is where risk management is the key. I'll come to in terms of risk management as well coming, and that is a very good question. So in this case, you see the first time it went up, it came down, it took support. Second time it went up, again it came down for the third time. Now I can see a pattern happening here. You know, every time it comes down, it's not going lower low, it is making higher lows, whereas the momentum, the trend is towards the upside, but every dip is giving you an opportunity to probably buy into the market or invest into the market if you're looking at a long term investment. Now, in this case, the third time it gave you a confirmation, the fourth time is where you take a decision whether if you want to buy. If you want to be a little more aggressive, people wait for two confirmation and also enter on the third one. Whether you enter on a third confirmation, fourth, or even a fifth confirmation, it is always ideal to make sure that you have risk management in place, because one news that could change the entire technical analysis could pop up at any given point in time, and you should always be ready to anticipate news that we cannot predict. So that is why stop losses or risk management is always the key to becoming a successful investor or a trader. Now, this is your downtrend, this is your uptrend, and this is your sideways. Pretty much similar to what we saw earlier. Sideways is a very good opportunity. Sideways market is always range bound. It trades between two particular prices. In this case, we are looking at the prices going up till 159, and on the downside, it is coming down to 155. So, if you would like to take advantage of both direction of the market, you can buy on supports, sell on resistance, buy on support, sell on resistance, as long as the range continues. Now you might get this channel even on a uptrend and downtrend market as well. So these are known as channel. This is a sideways support and resistance. Now, looking at now, since we've got the basics in terms of support and resistance, now there are different patterns that these support and resistance form. So initially we looked at line charts. So basically all these patterns are based on those line charts. Okay, I'm sorry. I think I've just got a question. I was just reading that question. It has been observed that the line it crosses the resistance and then comes back to few points. Maybe time and SL are taken mostly. All right. So I think what you're trying to ask me over here is, well, if the line crosses and if your stop loss triggers, what to do next? What I'll do is I will show you a couple of examples as well, so that it's easy to understand what happens if your line crosses and your stop loss triggers, what to do next and what you shouldn't be doing next. A lot of trading happens based on impulse, based on emotions. That is something we need to avoid as much as possible. It's always preferred that you wait for your signals, wait for things to fall into place. If the price action happens, then you take an action. If it doesn't, if it hits your stop loss, you always wait for the next opportunity, which I will otherwise cover in the next couple of slides, how to manage your risk. Now, these are few patterns that you will identify. I will try and show you on the live chart as well on a smaller time frame, so that we can identify few opportunities if we do get for the day. Now, this is a symmetrical triangle, as the name suggests. If you notice this particular line, so basically this is a line chart. It has come down and it goes back up. So every time it goes back up, it makes a lower high, but every time it comes down, it makes a higher low. Hence, it is symmetrical. The triangle is a symmetrical shaped triangle. Now you have an ascending triangle where the upside has proper horizontal resistance, but on the downside you can see every time it comes down, it is not coming down to make a new low. In fact, every time it comes down, it makes a higher low. So these are known as ascending triangle. So in this case, as the chart suggests, every time you find a breakout, that is your opportunity to enter. Every time you see an ascending triangle, it always comes after a market has given an upside move. It forms, basically it is known as consolidation as well. After it consolidates for a while, it continues the trend, and these are trades that you can do on breakout. So it is not always necessary that you need to buy on support and sell on resistance. You can also wait for patterns which gives you a breakout confirmation, and then you enter the trade, of course, along with your risk management in place. This is known as a head and shoulder. As you can see it, this is a reversal head and shoulder. This is a proper head and shoulder, which is on the upside of the market. This is the reverse side of the head and shoulder. As the name suggests, again you see there are two shoulders forming. So there's a shoulder that was formed, then the head, then the shoulder. When you get this particular pattern, this indicates that so the common line over here between these points is the neckline. So neckline is a crucial point over here. Every time a head and shoulder pattern is formed, once the neckline is broken, you can expect the markets to fall further. And how do you identify to what extent it can drop? It can drop to the extent of how far the distance between the head, the top point of the head, and the neck is. So this will give you your target price. Of course, I'm going to show you some of these examples on the live chart so it gets more easier to understand. But for now, it's just to understand what are the patterns that technical analysts look at, and what kind of targets or what kind of expectations they could expect when these kind of patterns form. Now, this is known as a cup and handle. As you can see, it has made a cup formation and there's a handle formation. Whenever you find such a formation and it gives a break above, it is a continuation pattern. So investors or traders buy after the breakout has happened above the cup and handle. You can see this blue line here, and of course they keep a stop loss below the handle. So in case it's a failed pattern, you always exit with a minimal loss. And pretty much most of these patterns work in the similar fashion with different features to different formation that it makes. This is known as a bull flag, which pretty much occurs many a times when you're looking at candlestick patterns or even line chart for that sake. This is a pattern where market has come up very aggressively and then it takes a break where it moves in a sideway or a sloping downward channel, and then once it gives a break above the channel, you can expect the market to again continue its upside, as the length would be as big as this initial rally. I will show you this also on couple of examples. Double bottom is very simple to understand. Every time you see the market come to the same level and bounce back up, we can expect a double bottom upside move. And of course, double bottom also has a neckline. Once the neckline breaks, you can get your double confirmation to enter into the market. You have double bottom, you have double tops, you also have triple bottom and triple tops. Pretty much most of them work in similar fashion. It only differs from pattern to pattern and how you take advantage and how you identify these patterns. Now, a very important tool that we can use along with these technical patterns that we had just discussed is one of it is your average true range. ATR is nothing but it helps you identify how many dollars can a specific instrument move. For example, let's say you're looking at gold and you're a new investor, a new trader, and you want to understand how many dollars can gold move in a single day. And this particular chart helps you identify how many dollars it can move in a single day. Now it tells you on an average how many dollars it can move. Please note that it does not tell you which direction gold can move in. It only tells you how many dollars it can move in a day. Now if you're looking at a weekly time frame, it will tell you how many dollars can gold move in a single given week. If you're looking at a monthly time frame, it will tell you how many dollars can it move in a single month. So it just helps you identify how many dollars it can move. So when the opportunity comes, you can anticipate how many dollars it could move in your favor, or also how many dollars it could go against you depending on where you are planning to invest. I will give you a couple of examples on ATR as well. And ATR is a very good tool for you to manage your risk and reward, and also help you identify opportunities, and also help you make decision whether that opportunity is worth entering into or it is not. Again, this is just an example of where you can find ATR. If you have not used a platform before, you can take a demo platform, and pretty much everything that you see on the live platform is there on the demo, including all the features, most of the features. If you go into the chart, this is the candlestick. I'm looking at the monthly time frame. You click on technicals. Once you click on technicals, you have variety of technical indicators that is already present in the platform. You click on studies. Once you click on studies, you get ATR. There's also a search button over here. If you cannot find it, you can directly type in ATR and it'll identify for you. Now, once you click on ATR, now I'm looking at S&P 500, which is an index, the top 500 companies of US put into one basket. So for those of you who are very new to the market, and if you're planning to invest into the best stocks in US and you're finding it difficult, S&P 500 is one of the benchmark that every market is analyzed against. So S&P 500, because it has the top 500 companies of US. So instead of buying 500 individual stocks, you might as well buy one basket of S&P 500. Now S&P 500, I'm looking at a monthly time frame. It is telling me on a monthly time frame, it moves about $236. Of course, this is an older chart. I will show you how many dollars it is moving as of today. But this is just to understand how many dollars it could move. In 2005, if you see S&P 500 used to move roughly about only $80. Then later it started picking up momentum and now it has reached about $236. So it is just giving you an indication. If you're new to the market today and you're looking at S&P 500 and you want to know, if I want to invest in S&P 500 on a monthly time frame, how many dollars can S&P 500 move, or how much percentage can S&P 500 move in a given month? That will help you make a decision whether you should be buying S&P 500 or not. Now, I hope so far most of what I've explained, the basics and the foundations has been covered. If you have any more questions, please feel free to keep writing in the chat. In the meanwhile, let me move to the live chart where we can look at a few of the indicators, few of the technical tools that we discussed today. And if you all have more questions on that, please feel free to write in the chat. The name of the platform is Trade Room. So if you're not finding, you can get in touch with one of our sales representative. They will be able to help you identify, find the platform, and also give you demo logins so that you can use those logins to log into the platform. Let me just share my live screen again. I hope everyone can see my screen now. Yeah. All right, so here, this is how the platform looks. If you're very new to the platform, you have product library, you have almost 12,000 instruments that you can trade on or invest in. You have commodities, you have cryptos, you have currencies, ETFs, forex indices, share baskets, shares. You all can go through this one by one. You also have biggest risers. So basically, it shows you for the day what has moved in terms of percentage wise, what has moved really high, what has moved on the other side, biggest losers also there. So pretty much most of the information is available over here in terms of products. Now let's get into how do we use these tools on a chart. Let's look at Apple. Now this is how a candlestick chart looks. We can change it to a line chart as well. So this is how a line chart looks. Let me remove the grid lines. All right, so this is how a line chart looks. Now I'm looking at a daily chart. Now, if I'm looking at the candlestick chart, this is how a candlestick chart looks. Pretty much the same, but now this has more information. Like I mentioned to you, each candle has more information instead of a line chart. Line chart just shows you the prices where it had gone till and where it drops. Whereas when you're looking at a candlestick, each candle gives you more information so that it helps you make decision more easily. Now let's look at a monthly chart. Now this is how Apple looks on a monthly chart. We can see the market has been going up. You've seen a couple of dips that has come into the market, and then Apple again eventually moving back upward. Now, if you look at the same thing on a 1 minute time frame, you can do so as well. On a 1 minute time frame, you see markets again pretty much moving in a range. Now you can see each candlestick representing every 1 minute move. That means every 1 minute you find a new candle forming. Right now we are looking at a candle that has started at 7:31. The minute it becomes 7:32, you'll see the candle pattern change. I'll just wait for just 10 more seconds. Yeah. So now the new candle has formed. Now this is 732 so candle which is in play right now. So and that's how candle patterns are formed. Now looking at this current scenario over here, we can identify trend lines and supports. You see this pattern here. You identified support. Now your resistance has broken out, so you see the market has broken this resistance, and you can expect the prices to drop further. Now of course you're looking at a 1 minute chart. You would not be able to trade on a 1 minute chart. This is just for example so that you can see live chart movement and how these patterns appear and how these patterns form. So basic support and resistance over here. Let's look at a longer time frame where it gives you a much better picture. Now we see Apple making a downtrend here. Now this is a much more longer time frame. Now if you are an investor who wants to invest into Apple, there are a few things that you want to consider. One is every time it is going back up, is it breaking above? In this case, it is not. So right now, most investors would wait for a price move that could happen where the prices can break above a certain level and then you buy it. So once a breakout happens, that is when you buy it. On the other hand, if you're someone who's looking to buy at lower prices, now you start looking at supports. Now let's look at a weekly chart. Now on a weekly chart, you will find supports more easily. You see these were prices where Apple actually had bounced back up from. You will see more supports lower end over here. Now when I go back to my daily chart again, now let's look at how many times the price action happened at these levels. So we see the first time it dropped here, the second time it came here, it bounced back up. The third time it reached the level below, so hence a second support has been formed. But more or less every time it has come, at least in the recent couple of months, when the price has dropped. I'm sorry, I think the font might be a little smaller for you. I'll just increase it. Every time the price has come to a range of 130 or 138 is where the prices has seen a significant rally. So now the next time it comes there, that is where someone who is looking for a long-term investment would look at buying. But anyone who is looking at a short-term investment also would look at buying at those levels. But a short-term investor or a trader would not wait for it to go back all the way back up. Probably they'll just wait for a few percentage on the upside and then they buy it back. They book their profit or they exit the position. Now, this is very, very basic in terms of using support and resistance, but these are something that will help you identify. Now, since we see Apple is a much better buy at 138, you would not buy Apple at 146, especially when you're looking at a daily candlestick. But let's say the same analysis is done on a 30-minute time frame. Now, on a 30-minute time frame, we will see the market is clearly on a downtrend. So this is the wedge that we had seen earlier, or we could even look at this. So now you see the wedge has been broken. So as per the examples that we had seen earlier, once a wedge breaks, you take a short position and you expect the prices to drop. So now this is something that you can look at doing on a 30-minute time frame. Anyone who is looking at a 30-minute time frame is trying to take advantage of a daily move. Maximum they would look at is next 3 to 4 hours or maximum 1 day moving to take advantage of the market. But if you're looking at a daily time frame and making a decision, you're not looking at trying to make a short-term gain. You're most likely looking at taking advantage of a weekly or a monthly gain. And anyone who is looking at a monthly time frame is purely looking more towards holding on to an investment for more than 6 months or probably even for 2 to 3 years from here. So that is what the time frame helps you with. If you're looking at a 5 minute chart, it is something that you're looking at to take advantage for the next 30 minutes. So on a 5 minute chart, I've just placed the 5 minute chart. Let's look at what is happening right now. We see this resistance here and we see the support here. Now, this is a symmetrical triangle. So, basically, a symmetrical triangle that has formed after dropping. So, that means if a break below this happens over here, you could expect the prices to drop further. And how much of a drop can you expect? You always measure your drop based on how much previous drop had happened. Now in this case, you see a drop over here. That's about 4% there. So if this break does happen, you can expect it to drop another 3 to 4%. Now, of course, this is on a 5 minute chart. On a 5 minute chart, you cannot expect a 4% drop to happen in the same day. But if you look at a 30-minute chart, 30-minute chart, probably you could expect this 4% drop to come within probably next 2 days. But in terms of your entry, the breakout has to happen and only then you enter. Now, to make things more easier and for you not to identify, so basically, I covered all these basics for you to understand how it works before you let the system show you how it works. So, we also have a tool where it helps you identify all these patterns. Let me go to the tool. So on the top, you find this pattern scanner. If you click on pattern scanner, you get breakout patterns, whereas emerging patterns. If you'll remember in the basics that we discussed, a breakout pattern is only once it comes out of the range is when you get the opportunity. And these are patterns that is helping you identify breakouts. So I'm going to click on breakout pattern for now. Just make this bigger. All right. So we have breakout patterns. What are the different types of patterns which we saw earlier? Triangle, wedge, channel. I'm going to select all of them. You have double bottom, you have double top, you have triple bottom, head and shoulder. Now the system by default can identify these patterns for you. But however, although the system can do that for you, I would highly recommend that it is best that you identify the pattern first and learn how the pattern works, learn how the behavior of each pattern works before getting into the system. And then once the system identifies for you, it will be more easier for you to anticipate what kind of move is expected from each indication. Now I've selected three patterns for now: triangle, wedge, and channel. Let's select some of the products, and I will also select the time frame. If you remember what I said about the time frame, if you're looking at a 15-minute time frame, that means you're expecting your returns, or you're expecting the move to happen probably in the next 30 minutes to 60 minutes. If you're looking at a hourly chart, probably you're expecting your results or your returns or the move to happen in the next probably 1 hour to even 4 hours. If you're looking at a 4 hour time frame, it goes anywhere between 4 hours to next probably even 2 to 3 days. On daily chart, you can look at a view for even a weekly time frame. I'm selecting all the four for now. Now the system also bifurcates, which is a strong indication, which has giving you a much more higher probability, and it rates based on the probability. You can filter the probability. 5 star means there are high chances of that particular pattern working out in your favor, whereas if it's just a single star, less probability of it happening. So you could always go with a higher a star. And let me just reduce the number of instruments so it's more easier. All right, so Nasdaq, again pretty much similar to S&P 500, is the top 100 stocks put into a basket, top 100 technology stocks. Now if you click on this particular pattern, it gives you an indication over here. So basically, it was forming a descending channel pattern, which is a bullish pattern, meaning if there is a breakout above this pattern, we can expect the prices to move higher. Now, this also gives you targets. Now, once the breakout happens, it gives you a signal to enter into the market. Your target is basically the topmost being your target 3. In between will be your target 2, and the first one would be your target 1. Target 1 will give you a lower return, whereas target 3 will give you the highest return. So now in this case, let's look at how much return you could possibly make on this particular trade. So the breakout happened here, and once you enter here, your first target gives you a return of almost 0.8%, almost 1% return. Your second target is about 1.5% return, and your third target is about almost 2.8% return. Now, once you have identified what kind of return you're ready to take advantage of, this also gives you the first most important thing before you enter the trade is your risk management. Patterns do form, patterns also do fail. Although it has given you 5 stars, pattern could fail if there is a sudden news that comes out in the market which nobody anticipates, and things could just turn around and go south. And this is where your ATR will help you in terms of how many dollars you can keep as stop loss. If you do not want to use ATR and you're expecting to make a return of almost 3%, your minimal stop loss should be 1.5% from your entry point. So 1.5% is roughly back low at this point. So this is where you would keep your stop loss. This is where you would enter your trade, and this is where you keep your take profit. Now your risk reward becomes good because you're risking 1.5% to make 3%. So your risk reward is 1 is to 2. Always make sure any trade that you take always is worth taking the risk. If you're getting a risk reward of 1 is to 1, which is still good, but 1 is to 2 or 1 is to 3 is much more better. Prefer 1 is to 2 risk reward ratio most of the time. Now let's assume we do not have these indicators giving you take profit or stop losses. In this case, this particular pattern has given you indication as to where Nasdaq can go. But let's assume you did not have this particular indication. You only have your pattern which you have identified yourself, and now you're entering into the market. Now this way you go to your ATR, you go to technicals, you go to studies, you click on ATR. Okay, now what is my ATR telling me? Just to recap, ATR tells us how many dollars a specific instrument can move in a specific time frame. I'm looking at an hourly time frame. In an hourly time frame, at this point in time, we can expect Nasdaq to move about $86, which is a good move. Now, if I look at a 4-hour chart, on a 4-hour chart, Nasdaq can move about $143. If I am looking at it on a weekly chart, on a weekly time frame, Nasdaq can move $700. Now, why is this important? It is very important, especially when we want to know if it is it worth buying Nasdaq today. Because if I'm looking at Nasdaq, let's look at Nasdaq on a monthly time frame. Nasdaq in a month can move about $1,500. Okay, what has happened this month? This month we see, if you all can remember the candlestick pattern, market has opened, and this month is still running. So the candle has not yet closed. Candle is still open. The previous month it had opened over here and it closed here. So that was a close of almost $600. Okay, but as per my ATR in a month, Nasdaq can move about $1,500. Now, $1,500 could include both upside and downside. Now, let's look at how many dollars did Nasdaq eventually move last month. It moved about $1,400, pretty much close to the average movement. Now let's look at how many dollars can Nasdaq move this month. It has moved all the way as low as $1,800, and currently it is up at $1,500. We have got a $1,500 move on the downside. So if you are planning to buy Nasdaq today, is it worth taking the risk of buying at these levels? I would say to an extent it is a good level to buy because Nasdaq has already dropped by $1,500, which is the average movement. The average move has already happened towards the downside. Best case scenario before the month ends, we could expect Nasdaq to go back higher a little bit. or even if if Nasdaq closes on the lower end, probably next month we could see a bit of recovery. Now, this just on the assumption on the ATR movement. We cannot assume a move upward would come just based on ATR. This is just one of the uh, logic that you could implement before taking any investment decision. Has the market giving you a discount to buy? Yes, it has given you a discount. How many dollars has it given you a discount by? $1,500. So that is pretty much close to the average true range. Now, how much percentage has it come down by? If you look at from the open to close, Nasdaq has come down by almost 7%. Now, is 7% discount for this month a good enough discount? That is something that we have to take decision on. But this just ideas, not a trade recommendation nor an investment recommendation. These are just few examples that I'm giving you so that it helps you make your decision more easily. Now, of course, I cannot use a monthly chart to take a decision on my 1 hour candle time frame. Now, my 1 hour candle time frame is telling me, assuming that this particular instrument did not give you a take profit on 1 hour when you enter. Let's put an example. Let's take a buy, or let's say you're going to be buying 1 unit. 1 unit of Nasdaq is $11,000, and you will be entering when you find the breakout. So when did the breakout happen? Over here. So assuming that you entered at the breakout level, okay, and now you do not know where to keep your take profit. You do not know how many dollars can it go up by. This is where your ATR helps you. Your ATR is telling you it can go up by $85. So you can put 85 points. Each dollar move on Nasdaq is 1 point. 1 point is equivalent to $1. So since I'm buying 1 unit, I can expect it to give me $85. So if you look at the blue line, it is your first target is your ATR. Now your second target is usually double of your ATR, which is almost let's say about 180 $190. The third will be pretty much 3 times or 4 times your ATR. Now let's say on an average 1 hour moves only $80. You can always quickly go and see on a 4 hour chart how much you can expect. So on a 4 hour chart it's showing about $140. So you can keep $140 take profit. Go back to your Ali chart where you identify the signal, and you can keep an on an average take profit of $140. Now at the same time, since you have identified your take profit, similarly your stop loss. Your stop loss needs to be minimum $85, $86. So your stop loss comes below this pattern breakout, so which is a good thing. If it's a failed pattern, when it comes back down, you exit with minimal loss. But if it continues going up, you can always extend your take profit and also increase your stop loss. So in case market drops back down, you book a minimal or no loss. But in the case where market continues going up, you can maximize your profit. But the places where you do not want to alter your this one profit or stop losses, it is best to keep your stop loss, best to keep your take profit as per the ATR. You take the trade based on your indication on the chart pattern that has indicated a signal, and you close your account. You do not look at the position, because the more you look at it, the more tempted you would be to alter your position, and this is where the discipline fades. As long as you maintain the discipline, you keep your stop losses, you have risk management, you have calculated your risk reward equivalently on all your trades. Now, probably there are some trades which might not give you as big move as Nasdaq is giving you $84. Probably gold is something that can move only $8. It cannot move $80 a day, but it can move $8. So on gold, when you put your ATR, you can put similar ATR, but in your quantity you can always make it 10 units. So 10 into $8, you make $80. If it goes against you, you lose $80. If it goes in your favor, you can make $80, or you can make $160 if you keep double the ATR. Any questions so far? I hope what I've explained to you has been clear. Let me try and show you maybe one more example on the breakout pattern. Let's look at a currency pair. Euro USD has been moving quite a lot. As most of you all should be aware that US dollar is strengthening because of the interest rate hikes. Hence, all the other currency against it is weakening. Of course, euro is also weakening because of Germany being impacted by oil prices. Now, let's look at euro USD has given you a descending channel, a bearish pattern. So basically, once the breakout happened below this, we can expect the prices to drop. Now, for those of you who do not understand how the point calculation works for currency, I will just choose a different instrument so it's more easier for you to understand. Let's look at a stock. Let's look at shares. Or we can actually look at even commodities if we have any signals on commodities. Okay, gold and silver. Silver giving you a very strong signal. Let's look at gold as well, which is not bad. Three is still a very good signal in terms of strength. All right, so here is a good example of what could happen if there was no stop loss. Let's simulate this trade. For those of you who do not understand short selling, do not worry. Short selling is nothing but instead of buying the market, you can directly short the market without buying it. Don't worry how it works. Just understand what is the logic behind why people short the market. If you are shorting the market, you are expecting the prices to go down. Meaning, if the prices go down, you make money. But if the prices go back up, you lose money. So, just very basic to understand what shorting means. Now, let's look at this particular example where gold gave a breakdown. So, this is a bearish candle, meaning it is giving you a signal that the prices are going to drop. Now it has given a breakout around these levels here, and you take a short position. And now we need to identify our stop loss and take profit. Now we go back to our ATR. What is my ATR telling? ATR is telling me on a 4 hour time frame, gold can move $12. So my minimum take profit would be about $12. Okay, so your entry is at 1626. If it goes down by $12, you make profit. Now, minimal stop loss you need to keep also would be about $12. But if you want to manage your risk reward as 1 is to 2, you can always keep a $6 stop loss. If you're keeping a $6 stop loss, you can afford to keep a $12 take profit. But if you're keeping a bigger take profit, then you can always increase your stop loss. Do not worry about how many dollars take profit and stop loss to keep. Let's say even if you have to keep a stop loss a little higher and a take profit a little lower, you can always adjust the number of quantity. So let's say I don't want to risk $126, but I'm okay risking $80 like the previous trade. So every trade, irrespective of the instrument, make sure your risk amount and the reward amount is almost the same. If in one trade you aim to make $1,000 and in another trade you aim to make only $100, that is going to spoil the risk reward. So in this case, let's say if I do 8 units, now I'm risking $100, but my motive is not to risk $100. My motive is to risk only $60. So $80. So I take about 6 units, where my risk now is come down to 80 as per my risk appetite, and my reward is about $100. Now coming back to the ATR, ATR is telling me it can move $12. If you can see over here, it is showing $12. So if I'm risking $12, I will. Sorry, if I'm looking to make $12, I'll keep a $6 stop loss. Now let's see what happened. This particular indicator has given you a signal. Now let's assume you did not have a take profit. You used your take profit purely on ATR. Now let's see what exactly happened over here. I'm going to go into a smaller time frame so you all can see what happened. This was your pattern. It give you a breakdown. It came down to a certain level and then you see it bounced back up. In this case, it was lucky. It came down exactly by $12. So your take profit triggered. And when it went back up, you did not have to incur a stop loss. But there could be cases where it came down, maybe it missed by 10 cents, 20 cents, and it bounces back up. That is just unfortunate, but do not worry about it. As long as you're consistent with all your trades in terms of taking the trades based on the signals, based on the logic, where you're double confirming with your ATR, double confirming with your support resistance, waiting for a confirmation of a breakout and then entering. As long as you follow all of these disciplines, one or two, when it goes against you and hits your stop loss, should not be a problem. The main problem where a lot of traders lose money is when they're very inconsistent. One is by not keeping stop losses, or after taking the trade, increasing the stop loss, or trying to increase the take profit, or some even have the habit of decreasing the take profit. So you increase the stop loss to $138, but we book a profit of, let's say, only $40. Now, the next trade when you take, let's say the next trade hits your stop loss of $150. You need to take at least trades, 4 to 5 trades, just to cover a stop loss done by one single trade. So, hence, it is always advised that you keep your stop loss, take profit based on your ATR, based on if you're not using your ATR, make sure you keep your stop losses. Let's say if you have kept a stop loss this high, make sure your number of units is always reduced. So if I do 5 units, now my risk is only $80. Now let's say if I don't want to keep my stop loss too close by, I want to keep it further away. But the further away you go, the bigger the stop loss. So I will reduce my number of units to now 3 units. Now if I do 3 units and if it goes against me, I still risk only $80. So this is how you can optimize each of your trade using technical indicators to maximize your profit. At the same time, very very important to make sure your losses are always under control. If you can master the discipline of if you can master to be disciplined in all of your trade and have a good risk reward ratio and have proper risk management in place, I'm sure you should be able to identify good opportunities in the market and take advantage of it. There are a couple of patterns that gives you high probable trades as well. Just because it gave you good trades or profitable trades for the last 10 times, that does not mean the 11th time is going to be a profitable trade. So keeping consistent investment value, stop losses, take profit is the key. Because it gave us profit the last 10 times. Let's say I do, let's say this particular gold trade or this particular indicator has been giving me consistent profit for the last 10 times, and every time I took the trade, I've taken a risk of, for example, I'll just change my chart. So if you don't have to look at the chart for now, let's just focus on the stop loss and take profit. Yeah. Now let's say I had taken trade worth 5 units, which is about $8,000, with a take profit of $80, for example, $80, and a take profit of $160. Now, let's say after identifying, after getting my signal, I have taken these trades, and for the last 10 trades, it has given me consistently $160. Now, it is human tendency to start believing this particular pattern works, and the next, what I'm going to be doing would be I'm going to increase my number of units because I see the pattern working to 100 units. Now, let me, sorry, not 100 units, 5 units, 1642 and 159. Yeah. All right. So I'm looking, and for those of you who are not able to understand the buy or sell, let me just make this. Yeah. So stop loss, let's assume, yeah, 1627, and take profit of 180. Yeah. So Now let's say pretty much similar indicators has given you consistent profits. You've been able to make $180 consistently. Now it is human tendency for us to always say let's do, instead of 5 units, let's do maybe four times more. Maybe you take 20 units. Now in this case, what happens is yes, your profitability increases, but so does your risk. So, but if you still remain consistent, what happens is your stop loss always has a fixed risk that you have fixed for yourself, and take profit also has a fixed return that you're expecting after taking a risk of 80. So, it's always very important to have a risk reward of 1 is to 2, and very important for you to identify how many trades, how many dollars are you willing to risk on every trade or investment you're going to be making. Now, this risk reward is very, very important for those of you who look to take advantage of short term moves in the market. Pretty much the same fashion for anyone who is looking for long term investments. But if you're looking at a long term investment, it has more to do with how much money you're investing, and how many stocks and what diversification you're doing into your portfolio. But in terms of understanding where to buy and when you should be looking at buying markets, technical indicators will help you identify there as well. I hope today's session has been informative. I hope it was a value addition if you're already a trader in the market or investor in the market. Please feel free to give me your feedback. If you have any other questions, you can drop in. If you want me to cover any topics in the future, please feel free to write in the comments. I hope the basics, and more importantly, how to manage your risk, how to identify opportunities, but most importantly, how to mitigate risk is also been understood in today's session. I would really appreciate all your feedback. Hope to see you all in the next sessions that we're going to be having. If you all want any demo accounts, if you want any more information, if you want more training, or if you have any queries at all, please feel free to get in touch with your respective relationship managers, and they'll be able to help you out. Hope you all have a good day, and hope to see you all again soon. Thank you.